Hello, my name is Justina Erickson. I'm going to be presenting on a real-world financial statement analysis for Home Depot Incorporated. So the first thing we're going to take a look here is at the performance ratios. The first set of ratios we're examining is the liquidity ratios. So this is how feasible or easy it would be for Home Depot to convert assets into cash. You can see their working capital is positive, so that's good. However, they have some concerning ratios in their current ratio and their quick ratio. The current ratio is above 1, so that is good, but it's marginally so. They would want to see a bigger cushion here to be on a better road. Quick ratio, very similar to current ratio, only it excludes inventory, which is a little harder to convert into cash. You can see here that this ratio is actually pretty low, which could suggest a struggle for Home Depot to pay its debts. So the next ratios we're going to look at are the solvency ratios. So this is some ratios that represent the business's ability to meet their long-term obligations to debt. So this first set here is debt to equity ratio. You can see that the equity doesn't cover debt and is actually very concerning for an investor. The times interest earned is not as concerning, but again here below you can see the debt to asset ratio is again concerning. The assets do not cover debt. There's a low degree of financial flexibility here with the debt to asset ratio being close to 1, which is very concerning for an investor. So the next set of ratios is profitability ratios. So this is basically the ability of a business to turn a profit. Everything here is actually in line with the industry, so there's nothing that's really a red flag or concerning to an investor looking at these ratios. Their gross profit ratio is around 34% and has been steady for Q2 and Q3. Their profit margin ratio is around 10%, which is a fair ratio. And then the asset turnover ratio, though it's a little high, is in line with the industry standard. So strengths here, Home Depot notes that they saw an increase of net sales from 2019 to 2020. A lot of this was due to the pandemic, and it increased demand for home improvement type projects as people were staying home. So they actually noted an increase in sales from 2020 Q3 to 2019 Q3 from 23.2%. This was largely due to online sale increases, which had a tremendous increase for the 2020 year of 87%. Their online sales made about 14% of their total net sales. The percentage of sales for their sales, general, and administrative costs for Lowe's, their top competitor was 21.4%, whereas selling and general and administrative expenses for Home Depot was around 18.1%. This is good, better than their competitors, also better than their competitor in terms of interest expense ratio. So Lowe's is around 10%, where Home Depot is around 6.7%. So I'm doing well there. However, there are some weaknesses. Treasury stocks were bought last year, which cost them a large amount for each quarter. They also listed a large amount of costs for their selling, general, and administrative expense that was increased by around 23% from what they had seen in 2019. So this increase in expense actually ate into their increase in sales, and so they didn't actually see much benefit from their increase in sales. Also, their assets do not offset their liabilities, which is very concerning. It creates a deficit for their shareholder equity, which we had gone over before. So trends, positive, they've been seeing an increase in sales, decrease in income tax rate from years prior. So we kind of mentioned that before, that they're running around 24% for their income tax rate. A few years ago, that was more in the 30s, so that's a good trend. Negatives, however, they are also seeing an increase in cost of sales, which is offsetting their increase in revenue. They're also seeing an increase in debt, which is decreasing their shareholder equity. So conclusions on the financial health, Home Depot has had a successful 2020 in terms of sales. They saw large increases in online sales, which is really a good benefit for them to grow that platform. However, the pandemic also brought about some more expenses for Home Depot, which kind of offset all of those good things. They had to spend more money on employees as they met with health challenges and quarantine periods. And so this increase in spending offset their sales and revenue. Home Depot is in a good position in comparison to its top competitors. That's good to note. They operate at a lower net interest income percentage than Lowe's and a lower selling, general, and administrative costs than Lowe's. They've also experienced a decrease in their tax income rate from years prior. However, the most concerning aspect for Home Depot is their debt. They currently have a deficit in terms of stockholder equity, and they have more liabilities than assets, or at least equivalent liabilities to assets. So until Home Depot gets a handle on their debt and their long-term outlook starts looking more favorable, I personally would not invest at this time. So that's my conclusion. Thank you.